Guys, welcome to the Syndicate, the show where we dissect the investors behind the startups. Today, we've got somebody who's doing it and doing it a little differently. Greg Robinson on the program, Managing Director of 4490 Ventures, which that's got to be the first question, Greg. What's with the name?
Yeah, it's actually, as you know, these things are hard to name and get anything that's interesting or meaningful out of. So we went with the latitude, longitude of the center of the state of Wisconsin. We're based in Madison, Wisconsin. So it's the center of the state of Wisconsin. And it usually begs people to ask that question. And hopefully it gets a few people to remember who we are.
And get a couple big cheese jokes in while you're at it.
That's right. Of course.
So you were at another venture firm and decided to go to West Midwest. What's up with that? Because I feel like there's a story here.
Yeah, for sure. Yeah, so I spent the bulk of my investing career out in the Bay Area with a group called Peninsula Ventures. We did classic early stage venture. But after being there for almost 15 years, as much as I love the Bay Area, there was a couple of things that were going on. One, the ecosystem of venture was changing. And two, I was kind of itching to do something different. And, it was kind of at that point that, through some good luck and good fortune, got connected with a couple of very large investors in this part of the country that wanted to deploy more capital in this part of the country, and really saw the opportunity where there was a lot of what you'd consider kind of the raw ingredients to innovation here in the Midwest. And one of the things that was lacking was really the capital to support all those engineers, those founders, those domain experts that really had a lot to offer in terms of creating these next generation companies, but really didn't have a lot of experience in building these types of companies, and certainly didn't have the capital to do it. And so I saw it as a really interesting opportunity to take what I had been doing the last 10 or 15 years in the Bay Area and to apply that in a different geography. And although we do largely very similar types of investing here as we did in the Bay Area, doing it in a different geography really changes kind of everything about it, both in good and bad ways in terms of kind of some of the challenges, but some of the opportunities. So it was really with the idea of trying to take what was good and applicable that we were doing in the Bay Area and apply it into, kind of I would argue maybe a more fertile land in terms of just the amount of opportunities relative to the amount of capital.
So you said something there, but you also kind of glossed over something else. Something was changing in the Bay Area investment dynamic that you didn't like. What was that?
Well, I don't know if I didn't like it, but it it was certainly changing. When I got into the business in the early 2000s, by and large, funds were, measured in hundreds of millions of dollars, even on some of the bigger ones. And most of the early stage investing was done by non-professional kind of angels. And, what happened towards kind of my tail end, I left Silicon Valley in 2014. What was happening at that point was, a lot of the more successful funds had really grown with their success and become, big platforms where they could do multiple stages, they could do many, many sectors, they could do lots of geographies with that type of a platform. And then you had the advent of kind of the professional seed investor. So a lot of seed funds started to come about. And what happened was the folks like ourselves, to some degree, were getting pulled one direction or the other. And to kind of stay relevant in Silicon Valley, I think a lot of us looked around and said, we either need to go earlier on the seed side or try to do something similar or get yourself onto a bigger platform. And for me, I kind of saw a third option, which was do what I was doing, but maybe do it in a different geography. And so if you move to a place like a Salt Lake or a Boulder or even Portland or something like that, that would be the natural kind of off ramps. You could continue to do the types of investing that we're doing. And so that I actually started to go down that path and during that process got connected with some very large investors out in this part of the country that had a lot of money to put towards investing in this part of the country. And so Madison wasn't originally on my short list of places to come. It wasn't the natural place for me, initially, until I really started to look at the opportunity. But it fit in with what I wanted to do, which was to continue to invest in capital efficient, early stage. We primarily focus on software-based businesses, and do it in a way that was kind of consistent with what we had seen in the past, both in terms of valuations and capital efficiency.
So basically, funds were getting bigger because they were chasing the 2% management fees. Because they got bigger and it all accumulated in those places, valuations went up, and things kind of spiraled big.
Yeah, I mean that's a jaded view of things, but yeah, I mean certainly that was that could be certain groups' motivation. I mean, other things.
There's nothing wrong with that. That's just kind of how the dynamics played out.
Yeah. That's true. But I mean, I also think the way in which businesses are built these days, the cost of starting a business, the cost of scaling businesses, the cost of going after some of these markets that are now bigger, they also kind of allowed for some of that.
Move fast, spend money, and dominate the market.
Yes, exactly.
That's kind of real, but we don't necessarily need to break things. What's it like being a Midwest investor? What's different? What do you see about the startups you're focused on there that would be something East and West Coast guys wouldn't get?
Yeah, I mean, I think, there's both good and bad about being out here, as I mentioned before. I mean, the challenges of being out here, kind of first and foremost, maybe I'll cover those and then kind of end on the high notes. The challenges are, a lot of these folks they haven't seen big companies be built. And so having seen that playbook, or have mentors that have seen that playbook, or be around people that can just encourage them to run that play, it's absent. So it's trying to instill and teach and bring resources to bear that can help entrepreneurs do that. The other thing that I think coincides with that philosophy is that, a lot of times people's expectation of what they can and should build, it just ends up being a smaller vision. The idea of building $1 billion business is not, kind of what I think, initially gets people going. I mean, if they can build something that's, a $50 million business, that would be fantastic. That would be more than they've ever seen. So trying to get people to elevate their expectations and their vision, it's getting better and better every year. You see it, but it's harder. That's some of the challenges to be out here. What's great about being out here is that you've got, a plethora of really good engineering schools out here producing a lot of engineering talent. You have a lot of the Fortune 500 companies where people can get some great industry expertise and have a firsthand seat at seeing what the industry problems are, and then can roll out from there with key product and industry insights to develop those things. And then the last thing is, you have employees that are much more cost effective, I should say much more, but relatively cost effective.
Like half the valley. What are you seeing price wise?
Yeah, it's probably, maybe it's not quite half, but it's pretty close. And I think the more important thing than that is you have people that will be with the company for the duration. There's some real longevity, and there's not the job hopping, and which I think is far more destructive than even the high prices, personally. So you see people that are very talented, reasonably priced, and have a certain amount of longevity that, I think sometimes you can't find, or you struggle to find in the Bay Area.
So you get something like a 4x discount then if you have roughly half price devs, and roughly what's the valuation difference, what you're seeing versus what you were seeing in the Valley and what you'd be seeing today?
Yeah, it kind of depends on what stage and how, in theory, hot a company is. We just don't have the high, kind of crazy valuations that you would see. But I would say on the average, really attractive opportunity, the valuations are pretty close to, again, maybe not quite half, but pretty close. And, everybody does read TechCrunch and the same, they get the same information, and everybody wants to apply kind of the same metrics and things like that. But I think when push comes to shove on Series A for companies that we're seeing, I'd say by and large, it's pretty close to half, or maybe 60 cents on the dollar.
So most VCs want to focus almost exclusively, or as much as possible, on SaaS and enterprise, just because the margins are godly. You build something, you can scale it. and it's relatively easy to do. One of the problems I've seen is that not enough VCs and not enough money are chasing the big problems. They're chasing the easy problems software can solve. Thoughts?
Yeah, I think that's probably right. I mean, I to go after those really big problems or the really hard problems, you have to be thoughtful of two things. One is your time horizon within your fund compatible with the time horizon of that development. As we all know, even a good, SaaS company will take, 8 to 10 years to kind of develop from first institutional dollars to exit, more than likely. So that's a long time horizon. So if you throw on there something that's even more complicated in terms of the R&D, and that usually also means more complicated in terms of, go to market and even, kind of that first product market fit part of the company, it starts to run afoul with the time horizon for a lot of funds. And then I think the second piece you have is, do you have the wherewithal to fund something like that, or does the syndicate have the wherewithal to fund some of those things that are more ambitious? And so I think most of us try to look at what our capabilities are, both in terms of sector expertise as well as our fund capability, which is how much of this can we fund and from what time horizon, and that dictates the type of problems that we want to go after. For example, we want to try to push out as far as we can on the risk curve because we think that's where the best returns are for us. But even with that, we have to look at what is our capability to fund these things from a time and a dollar perspective. And so oftentimes, even though we'd like to go further out, we have to pull ourselves back in just a touch, just to make sure that we don't overcommit ourselves from a time horizon or from a dollar perspective on some of these projects.
What's that process look like with the partners and how you guys make decisions on who to fund?
I don't think it's terribly unusual. We're a pretty small partnership. And so, it can be fairly efficient from that perspective, unlike some of the bigger partnerships where you have more formalized processes or even subgroups within the bigger group. And so we tend to be more collaborative. We tend to be kind of more group consensus building because of the size, again, that we have. And then, we try to, keep each other honest on, who gets excited about what, and, are we, we don't want to necessarily all be super excited about the same thing, because that probably means it's too obvious to everybody. So you want a little bit of just comfort, and when you look at things and trying to figure out whether this is a really bad idea because it's really a bad idea, or is this just a non-obvious idea that will take some time and effort to prove that it is a good opportunity. And so we have the good fortune of having a kind of a small dynamic decision-making process. But I think what we're trying to do and where we're going after is, it's still a function of who we are as investors. What have we done in the past and have made money at and feel good about it? What have we done and lost money and have a lot of scar tissue and want to stay away from? And then probably the last thing that really factors into what we're doing is, we have a stated investment thesis around geography and types of investments, and that tends to drive a certain type of investment opportunity more often than not. And so those are things that will tend to find themselves into our funnel, and we'll evaluate.
For example?
Well, we sit in the middle of the country where there's a lot of big Fortune 500 companies, what we call legacy companies. So companies that are big into transportation, manufacturing, agriculture, even some fintech and things of that nature. So big companies with, lots of people kind of operating in, I think of it as kind of last generation models and whatnot. All those companies have opportunities to be either significantly innovated on or disrupted in some way. And so more often than not, a lot of the opportunities that we look at tend not to be, what's going to be kind of the next, development tool or piece of hardware that goes into a data center or something that goes into infrastructure, but more around disrupting these big legacy industries. And so, because of our our stated kind of geographic focus. We don't want to try to play with, folks that are going to disrupt the data center, for example. We want to to see what we can do to disrupt, healthcare or agriculture or manufacturing processes.
Big practical stuff. How do you think
Yeah,
about
exactly.
corporate venture arms? Do you work with them? Do you like to avoid them? Do you guys take funding from them?
Yeah, so, I'd say my view of corporate venture arms have changed over time. I think largely because a lot of the corporate guys are doing a much better job today than they were 10 or 15 years ago. We've actually invested alongside a fair number of them. And I'd say, we're always willing to have that conversation, and we'll encourage it if it makes sense from both the company's side and the corporate side. I'm always I'm very leery of, or at least have to be very thoughtful of, what happens if this investment suddenly falls out of the favor of the corporate VC because the strategy changes, or maybe
Like Google and Uber.
Exactly. I mean, we have one of those companies in our portfolio right now that, luckily it was a small strategic investment and company's doing well. So we're able to, kind of fill that piece of the syndicate without too much trouble. But you do see it a lot, and you have to be very thoughtful. On the flip side, when there is alignment and there's good behavior, then I think it can be helpful. But it's one of those things, it's a double-edged sword. And so you have to be very thoughtful about it. But where we invest, we tend to see actually more of it than I would have said in, kind of in the Bay Area or on the coast. So we have to be very thoughtful, and we certainly encourage it. And we have a lot of those conversations, but it's something you have to manage for sure.
Yeah, and getting the relationships for potential sales leads further on is huge for your startups, I imagine. I got one last question before we go to the lightning round, and that's, you founded a company, got really successful with it, and managed to exit the company. What was that like, and what do you take forward for founders?
I think the first thing, probably wouldn't have said this when I was going through it or was younger. I'd say, being at the right place at the right time, luck factors into a lot of this. And, hard work creates luck, but at the same time, we always have to appreciate, the luck of being, kind of the right person at the right place at the right time with the right product. And sometimes that works out for you, and sometimes you have to, keep with it and keep motoring. And so, I guess I say that because I look back and think I was very fortunate. I think I worked very hard. I, did everything I thought I should. And I feel like I was very fortunate, but at the same time, I think with almost 20 years of experience post sale of the company, I look at it and kind of realize how lucky I was and how unlucky a lot of other people are to be in have a great company at just kind of the wrong place, wrong time. And so the first thing I always say is, some of this is the luck of, the luck that you draw here. And then the other part of it is, I do believe that we all create our own luck, and we can create more and more opportunities. So, I just feel like I, have a little bit more perspective on that before. I think when I was younger, I just thought I was,
we want to take the credit for it.
Yeah, we're like most young men, I was overconfident and thought I was probably smarter than I really was.
I can't take credit for this, but I probably will anyways. Exactly.
Yeah, that's right.
Let's jump to the lightning round. What's
Sure.
the first investment you ever made, and why'd you invest?
The first investment I made, it was actually a SaaS procurement platform. So this goes back 15, 16 years now. I made it, probably, for a couple of reasons. One is I felt like the product market fit was very, very good, and the ROI was really strong. And I thought that was enough to make the company wildly successful. And it was my first investment. It proved out to be, the ROI was not enough to make the company wildly successful. There's all kinds of other dynamics that caused the buying and the usage of the system to be something that kind of confounded everybody around the table. So ultimately, we ended up selling the company. We actually made money on it, but it was far from the wild success that the metrics and the underpinnings kind of showed that it should have been.
What was the best piece of advice you ever got?
This applies in multiple different ways, but early on, the advice of the power of compounding interest. And at the time, I was looking at purely from a financial lens of, being on the wrong side of compounding interest can be very painful. On the right side of compounding interest can lead you to wealth. But I kind of look at it now more as, the compounding interest of the little things that we do every day, kind of the persistence of what we do in terms of habits and almost even the kind of the persistence of just sticking with something. Those yield equally powerful results, just like compounding interest does. So I kind of look at compounding interest as, more of a philosophy of life of, if you can do good things in small increments, but consistently, it'll lead to great things.
Yeah, one foot in front of the other.
Yeah, that's right.
It's crazy how it works. What technology or trend are you most worried about and why?
This will probably sound self-serving and maybe obvious, but the trend, the amount of money that's in venture now worries me because,
Is it a bubble?
I don't know if it's a bubble, but it's I think venture is maturing. It's become a valid kind of institutional asset class, but that means it's changing. It's already, taken a lot of different forms that, companies used to go public, and that yielded, kind of a new set of investors and a kind of a new cap table. And that's been pushed off a year or two or three with different types of investors and different dynamics. And that's leading to all kinds of different things. And, all this money out here is, creating opportunities for founders to cash out earlier. And, some of this stuff is great and some of it's problematic. And I just kind of look at, I've seen a couple of cycles in the past, and this one feels like it's, we're towards the end of a cycle with the amount of money. And, I think in some ways that's great because it allows more entrepreneurs to get funded and do things. On the flip side, it usually means that we overswing a little bit and we do too many companies, and then the LPs will cut back, and that'll have a ramification with the funds and entrepreneurs down the cycle. And it ends up being kind of a painful thing to clean up from. So it feels like we're towards the end of that. So that always worries me because I know at some point we'll go from this irrational exuberance and paying up for any good deal to, even the best deals have a hard time get funded. So I think we're going to be there before too long.
Could that crash happen at the same time the housing market and student debt crash hit? Because those are huge bubbles popping soon as well. Healthcare, that we'll see when that happens.
Yeah. I mean, I gotta be honest with you. I would have thought this would have happened a couple of years ago, and it's been pushed off, which is in some ways great.
The Fed's pouring money in despite keeping low interest. They're setting themselves up to die.
Yeah, exactly. So we've got some systematic problems that we're going to have to deal with here pretty soon. So I think it doesn't take much for LPs to be concerned about another part of their portfolio, and they kind of neglect the privates, which all of a sudden will have effects for a lot of different funds. So I think that it's probably not going to be led by venture and private equity per se, but it'll be led by something else. But it'll have a trickle down effect on kind of all of us.
Yeah, bubbles pop bubbles.
Yes.
What do you think? What anti-portfolio? Who's the biggest company or two you missed on? You had the chance and you said no or passed.
I don't think this is an anti-portfolio because hopefully I was smart enough to realize that this wasn't a deal for us. But we actually talked to the guys at Tesla before Elon even got involved. And as a guy who enjoys a good car, I saw this and it seemed kind of obvious that somebody should do this, and it was going to be a wildly better experience. But I could also see that it was going to take a huge amount of money and a long time before it would get there. And I think that proved out to be the case. It's been a wild success in many ways. But that's one that we looked at, we saw, we were excited about, and I guess for better or worse, we realized, going back to our early conversation about where we are on the risk curve, we realized that the time horizon and the capital required was something that we could underwrite. And also at that time, it was before Elon got involved, and some would argue that without Elon, that Tesla wouldn't have gotten anywhere anyway. So, but that's probably the biggest one that saw early on, really before the A, when it would have been great to have your been associated with it, but in the end, it was the right call for us not to get involved.
It happens, but you wouldn't be here otherwise.
Yeah, that's right.
Now, I got one last question for you before we start to wrap things up. And that's, if you had to give people one thing, a quote, a call to action, it can be anything, before you tell them where to find you, more about you guys, etc., what would it be and why?
A call to action?
A call to action, a quote, something you want to leave people or impart with, wisdom, maybe you want to meditate. It can be anything that you think would be beneficial for people to hear.
I guess, trying to think, it's a good question. For me, again, I think that, what we do is, and when I say we in the startup world, what we do is extremely hard. I think anytime somebody gets a company off the ground and gets any amount of revenue, I'm always kind of amazed, because it's a Herculean effort. So I always tell people, you need to enjoy the process. You need to have a passion about what you're doing, and because really the process is what it's all about. I mean, what most of us find is that when you get to the end, and that you get to that pot of gold at the end, and expect to have some real satisfaction out of it, you realize that the most enjoyable part of this was the really difficult part, and the really painful part, and the really challenging part. So I will tell people that, I want to work with people that have passion about what they're doing, and that also want to enjoy the process and can appreciate and bring perspective to the process. Because, as I said, getting these companies started and building them, it brings such high highs and such low lows, that having that perspective of kind of enjoying the process, I think is critical. Otherwise, I think you get burned out, or you drive yourself crazy, or you're just not happy.
Yeah, it's incredibly dangerous. People get we all kind of do. We all get our personality, our self-identity tied up in something. And it's either going big or it's going to slam to the ground.
Right.
More often than not, we're going to get busted up.
That's right.
Greg, where can people find you, find out more about 4490? How do you guys pronounce it? Do you say 4490?
4490, yeah.
Okay, that's a little bit better than 4490.
Rolls right off the tongue, doesn't it? 4490.
Right off the tongue. You guys can set up some geocaching, have a fun little game about it. I like it. Where can people find you?
Yeah, you can find us, if you want to find a little bit more about us on the web, we're at 4490ventures.com. You can reach me at gr@4490ventures.com. And, obviously, we're always looking for, talented folks that want to enjoy the pain and the process that they're going through, and looking for partners that are looking for people that have, a bigger vision, looking to conquer, big problems, big complex problems, and bigger markets. And, we'd love to talk to you.
And you guys are pre-A looking primarily SaaS enterprise type companies, right?
Yeah, we do what we call connected software. So it's really SaaS software, but connected typically to some other asset, like a data pool, like a piece of hardware, proprietary analytics, something that helps provide an additional moat around the company once it gets to scale. But we typically will invest Series A. We lead investors, price those rounds. And those are typically companies that are trying to raise $6 to $12 million. And we'll write half that check and bring in the other half with Syndicate partners.
Awesome. Thanks for coming on. And if you guys have a good fit for Greg, make sure to reach out. And
appreciate the time.
Go make it happen. And
okay.
Tell Elon.
Okay.
That would be an interesting dynamic. I would love to be an investor and be able to see what it's like behind the scenes there.
I'm sure it's a wild ride.
I am sure it's a wild ride as well. Autopilot, out of control. Thanks for coming on, and we'll talk to you guys again soon. Cheers.
Okay. Thanks, Matt.